More than 50% of all businesses shut down after the first 5 years because they didn't have enough profit. But what if I told you that you can get access to $250,000 in capital without a hard credit check, simple application process, and funds within 24 hours? Well, you can do exactly that using the revenue card. And in this video, I'm gonna break down everything that you need to know about the revenue card so you don't have to spend hours figuring out if it's right for you. We're gonna go through the full application process, how it compares to other cards, and whether or not it is the right choice for you. So the revenue card is designed specifically for small business owners who need quick access to capital, but here's the catch. It doesn't work like a usual credit card that you're familiar with. The biggest difference is that revenue does not rely on your personal credit score at all. That means if your credit isn't perfect, you don't have to worry because this card is entirely focused on your business's revenue. Now, this is where it becomes a real game changer for business owners who've been turned down by traditional lenders because of poor credit. Imagine not being able to qualify for a credit card or a loan because your credit score dropped due to past financial issues or a couple of late payments. With the revenue card, that is no longer a roadblock. It opens up doors to funding that would otherwise be out of reach for many business owners. For example, let's just say that you run a landscaping business that's been around for a couple of years. You have steady clients and consistent revenue, but your credit score suffered during the tight early days of your business. A traditional credit card might deny you or give you a small credit limit that barely covers expenses. But with the revenue card, they're looking at how your business performs, not your personal credit history. This is especially important if you're trying to protect your personal credit for something like a mortgage or a big personal loan. This card allows you to get the business funding that you need without putting your personal credit on the line. Now, let's talk about what it takes to qualify. If your business has reliable cash flow, you could qualify for the revenue card. It means that your business generates enough revenue to cover expenses and keep a positive balance. Specifically, they are looking for businesses that bring in at least $20,000 a month in revenue and have a daily bank balance of at least $1,000. So as long as your business is producing steady sales, you're likely in a good position to get approved. Now, let's cover why you want this card. First off, let's talk about the flexible spending limits. This is a huge perk, especially for growing businesses. As your business revenue increases, so does your credit limit. Think of it as a credit line that expands right along with your business. Whether you're handling an unexpected expense or jumping on a new opportunity, this flexibility gives you breathing room to make moves when you need to. Now, let's take a look at the fees, or should I say the lack of them. There's no annual fee, no application fee, and no draw fee. That's right, you won't be hit with any surprise charges. The only thing that you need to factor in is the factor rate, which I'll explain in a moment. Then there's fast funding. Once you're approved, you can get access to capital in less than 24 hours. If you've been in a pinch where you need to cash fast, whether it is to cover payroll, order inventory, or deal with a sudden expense, you know how valuable that kind of speed is. You also get dedicated support. Revenue assigns you a personal account manager, someone that you can reach out to directly if you have any questions or need help with anything related to your account. It's always nice to have a point of contact who's familiar with your business. But here's a real game changer. No credit score required. For a lot of business owners who struggle with personal credit issues, this is a big deal. Your approval is based entirely on your business's revenue, not your personal credit score. If you've been turned down for other business credit cards because of your credit, this could be the solution that you've been looking for. And while the revenue card doesn't impact your personal credit, it does help you build business credit. Over time, this can open doors for better terms and higher limits on future business loans. Just like with personal credit, your business has its own credit score. By using the revenue card responsibly and making on-time payments, you're building that score. Revenue reports your activity to the major business credit bureaus like Experian Business, Equifax Business, and Dun & Bradstreet. So not only that you're getting the capital that you need now, but you're also setting up your business up for even better opportunities in the future. While these benefits are great, there's one cost that you have to keep in mind, which is the factor rate. This is how revenue charges for the money that you borrow, and it's a little bit different from traditional credit card interest rates. The factor rate usually ranges between 1.1 to 1.5, which means that you pay back 10 to 50% more than what you borrow. So let's just say that you need to borrow $7,000 to cover a big purchase for your business. If your factor rate is 1.1, you'll end up paying back $7,700. The good news is that you don't have to pay it back all at once. You repay it based on your future sales, so your business's revenue help covers the cost. For example, if your revenue is $15,000 a week and you're required to pay back 10% of that revenue, you're gonna be making $1,500 weekly payments until the balance is paid off. This could take about 6 weeks, depending on how your business is doing. It's a flexible repayment plan, which can be a big advantage for businesses with fluctuating cash flow. Now, how does the revenue card compare to a traditional business credit card? With most business credit cards, you usually need to be the personal guarantor, which means that if your business can't pay, you're on the hook. That can be risky, especially if you want to keep your personal credit separate from your business. Traditional business credit cards also pull from your personal credit score. While many don't report personal credit bureaus unless you default, just by having an inquiry on your personal credit can affect your score. On the other hand, traditional credit cards often come with a grace period. That means that if you pay off your balance before the due date, you won't get hit with any interest. For example, you can have up to 50 days to pay off a purchase before any interest kicks in. The revenue card works works a little bit differently, since it's more like a merchant cash advance where you don't get that grace period. Interest starts accruing the moment that you use your flex line, but the trade-off is that you don't need a high credit score to qualify. But here's where things get a little bit more interesting. Unlike most cards, the revenue card introduces something called a flex line of credit. A flex line of credit sounds complex, but it's not. It's pretty much what it sounds like. It's a credit line that's flexible and adapts to how your business is performing. The better that your business does, the more credit that you can access. The idea here is that you're not stuck with the same credit limit every month. Your limit actually grows as your business's revenue grows, which gives you a lot more freedom. And the best part is that you only pay back based on your future sales. So instead of worrying about a set monthly payment, you can borrow what you need and pay back over time as your business earns more. This setup is perfect for businesses that has busy seasons and slow seasons, since the payment adjusts to how much you're bringing in. So if your revenue dips for a bit, you're not scrambling to make a big payment. And if things are going really well, you can pay it off much faster. It's a flexible and quick solution for small businesses. Now, here's a side-by-side comparison of the pros and cons. The pros is that there's no personal credit check, fast access to capital, funding usually within 24 hours, no annual fees, no application fees, and no draw fees, flexible spending limits that grow with your business, dedicated support, and reports to the business credit bureaus to help build your business credit score. Now, here are the cons. There's no grace period. Interest starts accruing immediately. It requires strong revenue to qualify, which might not work with newer businesses. It can have a high factor rate, so higher costs compared to a traditional credit card, and it doesn't help you build personal credit. So what does it take to actually get approved for this card? Let's break down the eligibility requirements to see if your business meets the criteria. Here are 7 things that you need to qualify for the revenue card. First is that you need to run a US-based business. If you're running a business outside the US, unfortunately, the card won't be an option, but as long as your business is based in the US, then you're good to go, no matter the state that you operate in. Next is that you need a separate business checking account. Even if you're a sole proprietor, you will need a business checking account, not a personal one. This is pretty standard for business credit, and it helps them get a clear picture of your business's finances. Next is that your business needs to bring in at least $20,000 in monthly sales or $240,000 annually. I know this might seem high for some newer businesses, but remember, they're not asking for a personal credit check. That's why they're focused on businesses with solid revenue. Next is that you need to maintain an average daily balance of at least $1,000. This is all about showing that you got healthy cash flow. If your account is consistently dipping below this, then you might have trouble getting approved. Next is that you can have more than 3 days per month where your account goes negative. They understand that sometimes your account might hit the red, but if your account stays negative for too long, then it's gonna be a problem. Next is that your business needs to be at least 1 year old. If you're still in your first year, the revenue card is not the right fit just yet. The card is aimed more for established businesses that have a little bit more of a track record. And lastly, you can't be in the banking or lending industry. This is a unique restriction, but if your business deals with finance services, you won't qualify. But for most other industries, you're in the clear. So if you meet those requirements, let's go over the application. First, you're gonna need to provide basic info about your business, such as your business's name, entity type, and address. Then they will ask for your personal info, like your social security number and contact details. But don't worry, they're not gonna pull your credit. They just need to verify your identity. After that, you sign a few documents to get the ball rolling on the underwriting process. Next, you connect your business bank account through a service called Plaid. If you're not familiar, Plaid allows revenue to quickly review your business's financials so they can make a fast decision on how much you qualify for. Once that's done, they will ask you to upload a few documents like your driver's license and a voided check. After all of that's submitted, you can get a funding decision in as little as an hour. And once you're approved, you can get access to your funds within 24 hours. So now you can confidently decide if the revenue card is right for your business. If so, use it to invest in your growth. To learn more about revenue, you can find the link up here or down in the description.